Hey everyone, Ben Nelson, the Everyday Real Estate Investor here with another episode of the podcast. Thanks for tuning in. And it's been too long because things just continue to change, but we have our lender expertise, Grant Schroeder from Academy Mortgage on the show again to get an update and chat a little bit about what's going on in the market. Grant, thanks for being here.
Yeah, thanks for having me, Ben. Always enjoy these conversations.
Awesome. Well, it's been, I think, a couple months. And, as I mentioned, things are changing, almost on a daily basis these days. So probably too long in between episodes, but let's get caught up on where we're at in the market and what you're seeing, and then we can talk about where things might be headed. So get that crystal ball out, right?
Sounds like a plan.
Okay, yeah, let's talk about the state. So actually, I'm going to step back a little bit because I think just thinking back to some of our previous conversations late last year, early in this year, kind of anticipating rates to be down at this point this year. We were talking about rates being in the maybe mid fives at this point, and here we are kind of on the other end of the spectrum here. Not quite to what we saw at other points in history, but definitely not where we maybe thought things were going to be. So let's talk about that a little bit and maybe what's causing that and some of what the Fed's been doing and some of those things. So ready, go.
A lot to unpack there. I'll try and take it one thing at a time. So yes, certainly back in May, we thought was going to be our pivot point as far as interest rates go. The rate of inflation was coming down. It has continued to come down. We're not going to see as much significant improvement over the next 5 to 6 months just because we're not replacing very high numbers from this time in the month in 2022. And typically mortgage rates follow inflation. Bonds hate inflation. And as inflation's moving lower, you start to see mortgage rates improve with it. The job market has proved a little more resilient than people thought.
Darn. Come on.
The thing that's really frustrating with BLS and ADP, the Federal Reserve even acknowledged this in their meetings just this past week. Some of the headline numbers look a lot better than what they really are. We've talked about it in past podcasts where you look at places like LinkedIn, ZipRecruiter, these private sector companies, they're seeing job postings drop. They're seeing the number of activity drop. Unemployment claims are starting to tick up, but a lot of this is not being reflected in the continuing jobs claims, the new unemployment data as part of the BLS jobs report. But the thing we're starting to see is you typically see 2 to 3 revisions after the original report. These last couple months, we've seen numbers cut in half from the original headline. So it's like they're trying to conceal, it almost feels like a little bit. There's a little bit of monkeying going on with the data. Like the job market is not as strong as the headline looks. And the Fed acknowledged that just this last week.
Interesting. Okay. I didn't see that.
One of the other things, the Federal Reserve gave a little bit of foreshadowing what's to come. They did not hike at this last meeting, but you look at their dot plots, which is basically their forecast through the end of this year and into next year to 2024. Right now we're between 5.25% and 5.5% as far as the Fed funds rate, which again does not directly affect mortgage rates. It's your consumer credits or variable credit rates, cards, variable rates on auto loans, variable student loans, that sort of thing, home equity lines of credit. They forecast that to still be, it was like 5.3 to 5.4. So that's telling us, okay, we have 2 more meetings. November is going to be a big one. We're probably going to see a 25 basis point hike. But they also indicated, they foreshadowed previously 2024 we'd see 4 rate cuts. And the market's been kind of preparing for that. Mm-hmm. But they've reduced it at the last meeting to 2 rate cuts next year. Basically what they're saying, they want to end 2024 at about 5.1%. So a 5 to 5.25 mark. They want to stay higher for longer. Which is good if they're not monkeying with the economy, being reactionary, because they tend to overdo it with rate hikes or wait to cut.
Yeah, overcorrection or just being a little too slow to pull the levers, right? Yeah.
They only have a couple levers they can pull. Yeah. And so I had this conversation with just someone yesterday. They're like, if the Fed's not going to cut rates next year, mortgage rates are going to stay high. Not necessarily. As the job market continues to crack, a lot of the economists that I listen to have been talking about, okay, kind of a mild recession or a slow recession. We're kind of in many industries, like real estate, just from a transaction standpoint, is in a recession just based on volumes, not on price points whatsoever. We've recovered in price points in most of the major metros, but there's several industries that are feeling that, and kind of end of Q4 into Q1, I think a mild recession is very reasonable that's going to occur. It's going to hurt some a lot more than others and hurt other industries. But the biggest thing is if we have certainty, or the Fed just isn't making a bunch of policy changes, that could bode well for the market, signaling a little bit more certainty for investors. We've talked about this in the past where, okay, the 10-year treasury is used as a benchmark against mortgage rates. It's not. Mortgage rates are based in bonds, what's called the mortgage-backed securities market, where they are packaged, securitized, bought, and sold. But because the 10-year treasury has a positive correlation with mortgage rates, people tend to point to that. And typically, we have 180 basis points to 200 basis point spread historically, which means mortgage rates are 1.8% to 2% higher than where the 10-year treasury is. Yesterday, I think we got up to 4.4 on the 10-year treasury. So realistically, mortgage rates should be 6.25 to 6.5.
But they're
7.5.
Okay, yeah. They got above 8 at one point, right?
Investments, yes. Investments did 8 and 9. Primaries, high 7s. We hit a 2-decade high in August.
Okay. I thought I saw
a
Yahoo Finance headline that it got above 8% at one point for finance,
investments, maybe low down payment or credit. Home buyers.
Could be. Yeah, I did not read the article. Shame on me. So I would say don't just read the headline, right? Dang it.
There's only so much time in the day.
Yeah.
But we saw a peak back in October, November of last year, but we pushed past that peak here in August. The Federal Reserve doesn't have to cut rates next year for mortgage rates to come down. If we get some level of certainty,
right there.
You see secondary investors, you see mortgage lenders putting in more margin relative to the 10-year treasury. We're at a 300 basis point plus spread right now because of all the uncertainty and the volatility. We see 1/4 to 3/8% swings in rates over the span of a week.
Yeah.
In 2021, we changed 1/8 to 1/4 in rate over an entire month.
Yeah.
And that's not healthy for a home buyer not knowing what their payment is.
Not only is it not healthy, it can totally change what if they're able to buy or not. Or
people who are tied on debt to income ratio from a payment standpoint.
Yeah.
You change 1/4 3/8 over the weekend when you've made your offer.
I've always found the house. Yeah. Oh, well, never mind. Right. So.
So it's important to constantly be checking in with your loan officer.
Yeah.
Whether someone's looking at properties, it's please reach out. I'm glad to help. Check in with me. I can tell you where rates are right now, but in 2 weeks when you find that home you want to make an offer, check in with me. Let's check numbers, make sure everything looks good.
Yeah.
So all that to say, there's several factors with the job market. A mild recession, which tends to help. We see recession in the United States economy, which we're seeing it in China. That's kind of a foreshadowing. But you tend to see mortgage rates come down because investors fly to safety. Recession, you see stock prices coming down a lot of the time, but bonds and the more certain return is where investors flight to, and that drives down the 10-year treasury. You see that drive down mortgage rates. And potentially, it might be just a good thing if the Fed stops monkeying with the economy, because maybe that lends a little more certainty to secondary investors, and you start seeing, okay, they haven't done any rate cuts, but that 300 basis point margin starts
shrinking.
Press.
We're back where it usually is.
Yeah. That
there's a bigger margin.
It's a slow dance that's been on for decades between the 10-year and mortgage rates, and right now it is. Yeah. So to your point, so there's a bigger margin there than usual, which is why rates are higher than they really should be, because there's so much volatility and uncertainty with the economy and with where the Fed may or may not go with their policy and their you see that in higher rates, higher costs from lenders and secondary investors. We've talked about this before. Make their money from interest on loans by servicing them, holding them. And a lot of times the break even, the cost up front for a lender, their break even is 3 to 4 years, collecting that interest over time. It's a long game. But when we have a spike in interest rates like we've seen, 4% over the course of a year, there's a fear from lenders that, okay, this loan is going to get refinanced.
Yeah.
And they're not going to make any yield on it. They're going to lose
they're protecting their yield. Yeah.
So you see higher costs up front, so they're making sure that they're still profitable. Because you look at the last several quarters, end of 2022 to Q1, Q2 of this year, we're just finishing up Q3. The average lender was losing $300 to $400 per loan after all operation costs, after everything that's going on. Most lenders have not been profitable for the last 2 or 3 quarters. That's why I'm thankful to be at a company like Academy. We have a very strong cash position. We're very well capitalized. We're privately run, so we're not beholden to shareholders like some of your bigger guys that have IPO'd, bigger companies. We're able to be a little more nimble, and we have a cash buffer. We've had people approach us about buying their company because we're in such a strong financial position, which is a huge blessing in a market with a lot of uncertainties.
Yeah. Yeah, good point. Yeah, kind of a big pivot here, but one of the things that I think is affected by the higher rates too is that, builders are, builders finance their projects. That's how they move forward with you. They're not working with cash for the most part. They're using leverage, and so now they're borrowing at a much higher rate than they were, a year and a half or so ago. We talk about prices coming down, things like that, or what's going to happen. Well, builders are either they did have some pretty good profits for the first couple of years, so there's still profit there, I'm sure. But they got to factor that in, right? Their holding costs have risen significantly on all of that, and so that's going to factor in to what they are going to sell their product for, and it's going to factor in whether or not they move forward on new projects, right? So we are starved for inventory still, and what I see is, 90% of homeowners having either owning free and clear or under 4% interest rate, so they're not coming to market unless there is some compelling reason to do so, life event, moving out of the area. A death or something like that, or just we just have to do something because we need a bigger house or we need it or whatever. Sometimes you just make that decision and you bite the bullet, but it's going to be rare circumstances, right? So you've got a very small fraction of the market that's you've got a high percentage that's not very motivated to come to the market. They need a really big kick in the pants to do it, right? And then you have builders that are, I honestly don't have any stats or anything offhand to substantiate this claim, but the fact that financing is more and that it's going to cost more, they're going to be in the economy questions and things like that. They're going to be a little bit slower to bring. They've been through this, a lot of them, right? Yeah. They've or what they think what it might be, right? I don't think it's going to be that, but they're just in general they're more hesitant because maybe they have been through the financial crisis, or maybe they know that builders have gone through that, so they don't want to go through that, and so they're just a little more skittish, right? And so the cost part plus the uncertainty is going to, I think, cause builders to bring inventory to market more slowly, and that's not good. That is not good, and you can't say. It drives me nuts when somebody points to one data point and is well, this is why the market's going to crash. So this is not what I'm doing. Yeah, this is not. Yeah, this is not what I'm doing here. But from a supply and demand inventories perspective, that alone is a big piece of the puzzle for prices staying up or even continuing to increase. Yeah. Where that teeter-totter balance of affordability and that where that equals out, I don't know. But there's definitely a huge lack of inventory, and that's not going to get solved anytime soon. In fact, it may get worse before it gets better. That's going to be a big thing to overcome and keep an eye on. So we're not going to see a glut of inventory.
No.
I
believe it's NAHB, the National Association of Home Builders, puts out a home builders confidence index every single month. And typically when it's above 50, it means the home builders are more positive, more bullish on the housing market. And I believe we've been above 50 for most of the May, tail end of the spring through the summer. We just dipped below that here in August. So I think permits and starts were also up in correlation with that. But we're starting to see that level off again. Because again, at the end of the day, builders are in this business to make a profit.
Yeah.
They're not an emotional homeowner that is attached to their home. They want to get a certain price. It's like, sometimes for certain people, new construction can be really awesome right now because the builders can pack in incentives. They can buy down your rates.
Subsidizing rates.
The problem most people don't understand is though that the builders are not doing it for charity. Like they are in it to make a profit.
Yeah.
Like you're getting your closing costs or your rate bought down. You're paying for that at a higher price of the home.
Yeah.
Which can still be a win for a lot of folks to achieve the dream of home ownership. But that's just something to keep in mind. It's such a small sector of the economy. I know everyone wants to point to new construction, the backlog of inventory. But the builders are going to continue to deliver that slowly to market. They're not trying to bring more supply necessarily to the market. They're in this business to make a profit.
Yeah.
So there are pros and cons there. I mean, we're certainly seeing right now this month, September, August, we're seeing a lot of first-time home buyers actually come out to purchase, whether they have a well-paying job, like several people that we've been in discussions with for months that are just like, okay, rates are in the sevens. I'm accepting this reality. I'm going to refinance in a couple years, but I have an opportunity to buy, and I want to buy a home, or I want a house hack and buy a duplex and be smart about my housing. I'm tired of renting. It's like, yes, rates are in the sevens, but we're seeing more and more people accept that. And I don't know what the tipping scale is, like you kind of mentioned, where between affordability and accepting reality versus where rates go. Yeah. But supply and demand, like lending is strong right now. The guidelines, it's not the Wild West of the leading up to the great financial crisis from 2005 to 2008. Yeah. Supply and demand is going to be our driving factor in so many markets. And as long as there's still that first time home buyer, which isn't a seller, they're taking inventory from the market. They're not adding inventory, selling and buying. But as long as they are still buying and wanting to purchase that home, this supply-demand imbalance is going to be a sustained thing for many years to come.
And I think that tipping point goes back to the affordability piece. It's like you can want to buy all you want, but if rates get to a certain, already a chunk of the market is taken out, right? Your income level that you need to be able to buy a home is much different than it was, a year and a half ago. And so that's what changes. And so that's where, and at least here in Portland, and I think in a lot of markets, we haven't seen, there's about the same number of homes on the market right now as there was this time last year. We have about the same amount of inventory when you factor in absorption. It's like 0.2 months or 0.3 months more. So it's like hardly anything. It's not even worth discussing. Like we're essentially the same pace as we were a year ago, even though rates are, well, I guess a year ago rates had gone up, but yeah, that's the fact. That's like, okay, income levels and all that. Obviously, these buyers are not. They must have. Probably have higher paying jobs, things like that. But the lower,
there's a large section of the population that just can't afford to buy a home.
Yes, and so that demand is gone, right?
Yeah.
So, but
maybe these people are buying a lower priced home, or they're like the monthly payment works for their budget because they so many people have come to realize I want to buy a home, and now is a good time. There are fewer buyers. It creates an opportunity to go one-on-one with a seller. We're still seeing bidding wars in a lot of areas, but to be able to get some seller credit, we've had so many people getting seller credit, buy down your rate, cover closing costs, knowing you're going to refinance in the next 2 years. You're going to have closing costs when you refinance. Let's see if we can get the seller to cover your upfront purchase closing costs. And because they know, okay, as rates drop, rates go down a quarter, I think it's 1/4 or 0.5%, and another 5 million people in the population, things become affordable for. And that's that many more buyers as rates drop that you then have to compete with.
That's exactly what I was going to just mention to you, is that the flip side of that is they're out of the market now, but they're waiting. They're on the sidelines, they're ready to jump in when the time is right. And so if you can buy that, what is that going to do? That's going to create a whole bunch more demand. We don't have a whole lot more inventory. And so, I mean, you didn't say this, but maybe you did, but it's a great time. I guess you did say it. It's a good time to buy if you can, because yes, your rates are higher, but it's not that prices couldn't come down. Obviously, none of us know. We don't have a crystal ball. We really don't know what the future holds, right? Most indicators, most of the forces are leaning towards prices continuing to go up.
Yep.
When rates do come back down, we're going to be in a different spot, but very similar to where we were before. Like, the floodgates are going to open up, and there's going to be a lot of people like, okay, now's our time. Here we go again, back to 5 or 6 or 10 offers instead of 2 or 3.
Yeah.
And what is that going to do to pricing? I don't know. I mean, we've seen it before, so it probably overlist, probably prices continuing to, be bid up, right? So, so buy now, right? Okay. Actually, one other thing that I was going to, as far as on the rental side, like as a landlord, we had crazy rents. Rents were going up 20, 25, 30% year over year in some markets for a while. Well, that's obviously stopped. So, it'll be interesting to see how interest rates affect that, because right now it makes a whole lot of sense still to rent. So, like, there are people, and especially we talk about the sector that's like maybe on the sideline right now, but they're renters right now, right? And so there's a pretty big gap right now in rent versus payment. And a lot of, this is general, right? Not in every market, but to where as a landlord, you're probably going to see some pretty steady rent growth over the next, foreseeable future. Again, inventory problem, that gap in payment for rent versus for mortgage. And so I'm bullish on rents in, moving forward. Are we going to see 10, 15% year over year? No. Okay. No, we're not going to see that. Although some markets have seen that still over the last year. Everything's local, right? You have negative rent growth markets right now, and you have markets that are still double-digit year over year rent growth. But, a lot of them are going to return to like more historical norms, but that's still, 3-4%. You extrapolate that out over 10 years, that's some pretty good income increase. So
buy real estate,
to see that.
Buy real estate and wait.
Yep, there you go.
Don't wait to buy real estate.
Buy real estate and wait, yep. Yeah, and we won't get into that right now. There's going to be, if you're multifamily and, looking at some of the commercial markets, there's going to be some opportunity there. It'll be interesting to see how that plays out. Yeah. I think banks will have maybe some flexibility with certain buyers.
Extending terms. Yeah, so we've already seen that a little bit. Yeah,
so I don't think there will be some distress.
There already is in commercial, especially office.
But. Yeah, for sure. Yeah, but I think it's probably not as much as if you just look at like, this many people have adjustable rates coming out. This many people have, variable loans. This many people have bridge loans that are coming due, and they're not going to be able to refinance. There's going to be some of that, but a lot of those
lenders don't want to take the property.
Yeah, I think there's going to be a lot. Yeah, because the equity's not there anymore, right? So it'll be interesting to see how that plays out, because normally a lender would do a capital call or something like that, where like, sorry, we're going to take the property back. Well, now they have that asset that. What are they going to do with it if the equity's not there, right? So there probably will be some negotiations working through that, rather than just calling a no due and taking the asset.
We're seeing a mix of both of those. Yeah. It'll be. I haven't seen anyone do a correlation between. Everyone likes to talk about commercial and residential like they're two separate things, but like a lot of your lenders, especially your middle tier regional local banks that frankly hold a lot of the commercial loans for smaller mid-size investors, but they also do residential loans. And I'm curious, they're already strained for liquidity with the current banking what was the current banking crisis, but also they have just gotten more reserve requirements leveled on them where they need to load up their books. So they're certainly pulling back, credit's tightening across the board. Like we were just talking about, lenders are going to protect themselves or find ways to work with investors in commercial. So I don't think there's going to be as much of a domino effect in commercial, there'll be a lot of different syndicators and owners that are hurting. But I'm curious to see if anyone is able to draw a correlation with if that will affect residential. I don't think so from everything I've seen, but I am not an expert on
Yeah,
that.
that's a really good.
I'd love to learn more about that.
Go down the rabbit hole there, right? Yeah. I mean, because a couple of things there. I mean, to your point, so, there's regulations there too, right? So they can't necessarily just say, hey, we want to work with you, because they have to meet certain like equity requirements on their books and all that. Like, so there's what they're willing to do, and then there's requirements that they have to meet and stand by, and so they may not line up. Like, they may legitimately want to work with a borrower and be like, we can't because we have to have these certain standards on our loans. And then the other point is, will it affect residential? I think the liquidity piece of that is the piece of the puzzle there, right? It's which is really kind of in the financial crisis what made the crisis worse was liquidity went away.
Loans too.
Yeah. And so when liquidity goes away, it's like you could have all the demand in the world, and it doesn't matter because nobody can act on it, right? Yeah. So, with reserve requirements and all these other things on top of them, and then if they start getting some distress within their portfolio, they may not be able to lend, and then now or as much. And that affects rates too, right? So like they may not be able to lend at all because they don't have the proper reserves, or they just need to be more conservative. And then what do banks do a lot of times is they don't just say we're not lending money anymore, right? Typically they say, well, yeah, we'll give you money, but here's the rate, right? To the point where
and the guidelines are very tight.
Yeah, it's kind of like a go-away bid. It's like, I really don't want to do this remodel, but like I'll do it for this much, So that's kind of banks do kind of the same thing. It's like, well, our rates should be 8%, but we can't right now. But if someone will give us 12%, sure, we'll give them a loan, right? So you really they kind of just disincentivize it, more or less. Yeah.
Like I could definitely see it hurting like your smaller regional commercial banks, your local credit unions. And not necessarily hurting their existing servicing portfolio from a residential, so I don't think people need to be worried about that because we are set up in the United States. I think it was like 85 to 90% of the loans are, if not more, are 30-year fixed in the residential. That's why we're so strong. You look at other countries, you look at the commercial market in the U.S., like the shorter term, 3, 5, 7-year notes that are coming due, they're variable, and that's also what helped accelerate the great financial crisis with those coming due
loans
all at the same time.
Yep, negative amortization loans, all in one. Yeah.
And I could see that like hurting liquidity-wise, like you said, with the smaller local regional banks, and basically just not lending or making the criteria so tight because they're trying to hoard liquidity as commercial assets are coming due or they're getting non-payers with those. Your independent mortgage bankers, your private entities like Academy, some of your big banks that work directly with the Federal Reserve, it's not going to affect them. They're still going to be lending. Credit is still available at reasonable terms. You might see rates move a little bit, but there's still going to be a lot of access to lending to capital in the residential markets just because the foundation with the 30-year fixed loans is so strong.
Yeah.
But
Yeah, I'll add one little non-political piece here. We have something coming up next year about this time, right? So, they're going to do everything that they can to keep the economy moving forward for the next year. So,
looking healthy.
Is there potentially a hammer that's going to fall at some point? Maybe. I mean, again, we don't know, and I'd say real estate and historically real estate typically everybody points to the financial crisis and this is what happens to real estate in a recession.
The short-term memory.
But historically real estate actually does really well in a recession because of a lot of reasons, but rates come down again, right, in a recession to try to spur the economy and there's a lot of reasons behind that, but everybody that back in the housing crisis, the recession, the recession before that, housing did really well in the recession before that. So, so a recession doesn't mean necessarily negative for housing, but I guess my point is that if something were to fall, it's probably not going to be in the next year because they're going to do
everything.
They are going to do everything they can to keep that from happening, right?
Optically robust economy headed into the election.
Whether it falls apart the year after that doesn't matter. it's just what happens the next year. So anyway, I'll just probably stop there. So
I mean, that's
just
how it
works.
Bigger Pockets put out an article just in the last couple days that they looked at Reagan, Clinton, Obama, like headed into a re-election year.
Yeah.
Like there's always like economic growth because that's such a focus on like there's positive stability headed into a re-election year.
Hesitant to make, even if they don't like the administration, they're hesitant to make a change. Change is questioned in the economy. You don't know what the new administration is going to do. Now, you might actually kind of do know, depending on who that change might be. But yeah,
stark contrast change one side or the other. Yeah.
Yes, big swings and all that stuff. So it'd be really interesting, not politically, to see how that plays out. And really,
especially with all the other factors going on in the economy at the same time.
And I'm going to borrow a little from the real estate guys here. Like politically, wherever you stand, okay, I'm not saying it's not important, but it's really from a financial standpoint and from a strategic standpoint, it's more important to know where things are likely headed, right? Because then you can position yourself. You may not like it, you may not agree with it, but you can still benefit from it and put yourself in a position to profit from it and to strategically do positive things, right? So there's always opportunity.
No matter who is in office, owning real estate is always a good thing.
Yeah, and you may change your approach or change your strategy or whatever, but that's okay, right? You just skate where the puck's going, right? It doesn't. Yeah. You may want the puck to go that way, but if it's going that way, it doesn't help to go this way. So, well, great. Let's talk a little bit about strategy. What you're seeing. What are you seeing? So rates are high, 8.5%, 9% for investor loans, right? So it doesn't make any sense to do anything as an investor, right? Just sit on the sidelines.
We have seen some incredible opportunities created. Whether through negotiations or off market. Like I said, our first time home buyers, our house, it's always a good time to house hack. Buy a duplex, live on one side, rent out the other, pay much less than you're paying in rent. That's a win. Eliminate or reduce your housing expense. A lot of clients doing that. Also seen a lot of investors just in the past month or two. It's like people all around are starting to accept, hey, rates are higher, but we've had several clients do what's called delayed financing. Now, most lenders, most loan officers don't understand how to do this, where everyone hears the 12-month seasoning requirement to do a cash out refinance at your ARV and or after repair value, for those who don't know what ARV is. And that's only when you're buying with financing. If you're buying with a hard money loan, private money, conventional, doesn't matter. You do a renovation, you want to do a cash out, you have to wait 12 months to do that. But if you buy with cash and then you do a cash out refinance, it's called delayed financing. The first key is buying with cash. The second piece, delayed financing exception, is the one that like 99% of lenders don't know. If you put your renovation costs on the HUD statement, your final settlement statement at purchase as an escrow holdback, so you're buying a property at $350, you're putting $40 into it. So your total acquisition cost is $390 in that example. $350 purchase, $40 in rehab. Most people don't think to do the rehab. You can do your renovations, 2 months go by. You can do a cash out refinance at your ARV. The max money you can pull out is your total acquisition cost. That's why it's smart to talk with the lender when you're burring to understand this piece. And the first key is cash. The second key is putting those repairs on the HUD statement. Being able to, most people they don't even think about it. They go purchase it, they do the renovations, they go cash out on delayed financing. They do the first piece fine, which is still a win. Get your acquisition, the $350 purchase price out. But the bonus, the delayed financing exception, is if you include the renovations as part of your total acquisition, you can pull that if your ARV is high enough out at that price point. We've had several investors doing that where they're cycling money. We've had an investor buy 2 duplexes down in Albany, Oregon. They bought at $370 cash. They did a few renovations, touch-ups, put maybe $5,000, $10,000 into each of the properties. They were pretty much rent ready, mainly cosmetic. They both appraised at $420,000. They walked into $100,000 equity in the span of 2 months.
Nice. Yeah,
Like
awesome.
there are still, like, we've had several investors using delayed financing, investors pulling cash out of rental properties, re-leveraging the equity. It's like, yes, I'm giving up my lower rate that I had for a higher one, but I'm going to go put this equity to work elsewhere and get a higher return. A lot of people are looking at return on investment, IRR, but there's a different focus when it comes to return on your equity. If it's just sitting there dead in a property that's appreciated, homeowners in America have so much equity in properties right now.
Yeah.
We're doing, like, we kind of talked about this before we hopped on air, like debt consolidation refinances. Visually, it hurts to go from a 3 to a 7. But if someone's got $2,000 to $3,000 in credit card, personal loan, auto loan, taxes owed, like I've had several clients, and we're getting more and more into this, seeing more cases like this where, okay, you're going from a 3 to a 7, okay, your mortgage payment's going up $1,400, but your total monthly cash flow in your budget, you're spending $3,000 on personal debt. It doesn't work for everyone.
Yeah.
But we always do an analysis. It's like, okay, you're saving $1,600 total in your monthly cash flow. Rates will come down. You have an opportunity to refinance your mortgage at a later date. But there are mortgage interest deductions. There are other wins with a home that you can't get with consumer debt. And even though, okay, your housing payment goes higher for a consumer or for an investor, sometimes from a return or just a monthly cash flow perspective, it makes sense to consolidate that all.
Yeah.
We're seeing that more and more just
Yeah.
because your home for most people is your greatest asset. It's built a lot of equity over the last several years.
Yeah, and I think one of the big things as an investor is that, we're kind of spoiled for a while, right? It's like I can borrow at 4 and I can go put it to work and I can make 15 or 20 on my 4% money, or 25 or 30. I mean, like it was crazy how much money people were, the returns were on syndications, and like rent growth was crazy, which we talked about earlier. So people were making so much of a spread on their, they're just arbitraging their debt to a point where it's like, well, geez, I'm just making this huge, and so like that's where you got to just kind of reset expectations, right? We talked about that from a retail buyer perspective. I always say like you can't look at your best deal and that you've ever done and say, well, I'm not going to do any deal unless it looks like that, because you know what, you probably, assuming you haven't done just 1 or 2 deals, if you've done quite a few deals and then you just had a home run on one, and it's like, well, I'm not going to do anything unless it looks like that anymore. You're probably not going to do a deal for a long time, right? Yeah. Your expectations, your bar is too high. Keep taking those base hits, right? Yes. So now, if your expectation is you're going to borrow at 4% and go make a 20-25% return on it, like don't even look. Like, what are you doing? Like, it's not going to happen. So now you're borrowing at 8. You can probably still put it to work and make 10 to 12 or 14 or 15, depending on what you're doing, right? There's still a spread there. There's still a margin. You can still arbitrage.
You have to adapt still. Yeah, you can still hit a single or a double.
Yeah,
to win.
Exactly. Yeah. So like, let's get maybe not so greedy on our arbitrage here, and realize that it doesn't make sense just because you can't hit these certain numbers that you were hitting before to not still put your money to work, right? There's still opportunity to do that. It's just we just have to maybe accept a little bit lower returns for a while, right? So I think that's a big, don't get so stuck on it doesn't matter what the debt costs, right? It matters what you can do with it. Yeah. People, hard money is too, like, oh my gosh, hard money is so expensive. I would never pay that much money for money. Well, okay, why? Like if you're making $100,000 on a deal and you paid a lender 30 for the money, who cares? Like, get over it. Like, they're in the business to make money too. It's a mindset thing. Yeah. It's a tool, and if the tool helps you create more equity and make money, it doesn't really matter what it costs. Yep. So don't use debt irresponsibly, right? Yes. You want to say, don't do that, but remember it's a tool. Again, I think I've said that. It's a tool. Use it properly. Don't use the chainsaw improperly and cut your arm off. Use it the right way. And it's I'm not Dave Ramsey, no debt guy, okay? So Debt is a great tool if you use it appropriately.
To buy assets, yeah.
Okay, so let's talk about, let's kind of wrap it up with one more thing here. We talked a little bit about what you're seeing people doing. You talked, before we got on, we were talking a little bit about debt service coverage ratio loans, DSCR loans, and this kind of this outlook that interest rates are going to go down at some point in the future, but we don't know when. And so talk a little bit about that and how investors are using those, because there's some nuances there where you need to be aware of it if you're getting into things like that, and you kind of have a couple products that might help people in the meantime too, like if rates were to come down sooner than later. So talk about that.
Yeah, so several things. I mean, we've talked about house hacking throughout this. We've had a lot of VA, FHA buyers maximizing those loans, buying 1, 2, up to 4 unit properties or properties with an ADU. We have a 15% down, no PMI investment loan we've been using a lot. You can go higher rate, lower cost, where most lenders will cap at like 8, but you're paying 2-3 points. They just cut the rate sheet off. We have some options to go like higher rate, lower cost. But then we've also been doing several DSCR loans, whether purchase or refinance for clients. So DSCR standing for debt service coverage ratio. And a lot of times you see that most commonly in commercial mortgages, where you're seeing 1.2 and 1.3 gross rents to total monthly payment, PITI. In residential, our target is 1.0. We can go as low as 0.7. But what most people don't realize is it gets pushed on bigger pockets a lot. Your DSCR loans, bank statement loans, asset-based, like more of your specialty products, are considered non-QM mortgages, non-qualified mortgages. Your conventional VA, FHA, traditional government-backed loans are considered qualified mortgages. And that's as a result of the qualified mortgage laws that went into effect in and around the great financial crisis to reduce the variability, prepayment penalties, that sort of thing. That's one of the big things, balloons, that make up a qualified mortgage versus not. So what most people don't realize with non-QM, it's all privately backed, and almost every single one of the entities has a 3 to 5 year prepayment penalty. So we can broker to those entities at Academy. We're a direct lender. Like we talked about before, one of our greatest strengths is how big our toolbox is, whether it's doing loans retail, portfolioing, doing brokering a loan when it's in the client's best interest. We have a multitude of solutions. And so a lot of these entities, we're getting quotes from our broker channels. They are minimum 3 years, sometimes up to a 5 year prepay. In an environment where people are going to be they're buying an asset right now, they're going to stabilize it, they're going to be refinancing in the next 2 years. And that prepayment penalty does not work. We're seeing more, like you used to have step down prepayment penalties, 3, 2, 1. So you refinance in years 2, you have to pay 1 year's worth of interest. That's what's left. We're starting to see 3x3 full prepayment penalties. So if you refinance in year 2, you're still having to, when you pay off that loan, to supply 3 months interest, 3 years interest to pay off that loan as a prepayment penalty. One of the things I love about, we have 2 DSCR loans in-house, and neither of them have prepayment penalties. That's huge. Like if the numbers pencil on a DSCR, maybe you're an 1/8 or a quarter higher, it's at the risk of the lender to not have a prepayment penalty right now. But you don't have a prepayment penalty, maybe a slightly higher rate, the DSCR is still 1.0 or as low as 0.7. You go to refinance in a year or 2, you don't have to worry about that prepayment penalty. You're not getting slapped with a bunch of money. It's like, okay, an 1/8 or a quarter, and right now it's like, that means nothing over the long term when you're looking at the finance cost long term of that 3 year prepay. That's a huge win. We've been doing a lot of those for investors right now, where we can do those in-house. DSCR, no prepayment, bank statement, no prepayment, asset-based loans. That's been a huge win for clients in this environment.
That's great. That's a great tool. If you are of the mind that rates are going to come down in the next year or 2 to the point where it makes sense to refinance, then that's a great tool, because otherwise you can still refinance if you're in the other ones, but you're just going to pay a big fee.
Giving up a portion of your equity, basically.
So that's a great tool. So, well, Grant, lots to talk about. We always have. I mean, we could probably talk for another 45 minutes or an hour about the economy and all the tools and strategy and all that stuff. But maybe I don't know. We love talking about it. Maybe hopefully other people will hear about it, but probably another hour or so is too much. So, well, but yeah, appreciate you being here, and we'll definitely make sure to keep having you on because things continue to change and move, and we want to make sure that everybody's kept up to date on what's going on. So,
Things are constantly changing. Yeah, appreciate you having me, Ben.
awesome. Yeah, thanks again for being on.